Hey, good afternoon, everybody. I'm Alba. I'm a partner in our government contracts group. I'm here with my colleague, Meghan Leemon. We'll do introductions in a second. So we're going to talk about this afternoon bidding major contracts and some of the compliance requirements I think people should prepare for now. And the reason this issue came up is, Meghan and I have been dealing with STARS 3, COSP 4, now Polaris, which is on pause, which is good. We'll see what happens with that. But so all these things have been happening, these major contracts, and people have been coming and seeking help to either do joint ventures or various teaming arrangements, mentor-protege relationships, thinking about how to structure their companies. And it seems people are thinking about it kind of too late. And we wanted to give this kind of presentation that would walk through some of the issues we think people could do even years in advance if they wanted to really get out in front of some of these issues. And this would maybe be helpful more particularly for like the next generation or things that are coming up in the summertime or next year or 2 years or 10 years from now. So with that being said, we can walk through some of these things. I'm Alba, again, a partner in our government contracts group, doing all things government contracts. And I'm here with my colleague, Meghan. Meghan, do you want to say hi?
Sure. Good afternoon, everyone. My name is Meghan Leemon. I'm a senior associate in our government contracting group. I deal pretty much everything GovCon similar to Cy, but I focus largely on small business issues. So for procurements, when people have a lot of joint venture questions, vendor protege, things along those lines, people tend to ask me. So I'm happy to help with those as we progress.
And that will be some major issues that we're going to go through. We're going to start out talking about company structure things. It's something a little unique that I don't think people necessarily think about possible use of some subsidiaries, thinking about long-term, the future, maybe, again, it might be 10 years or 20 years from now, who knows, but thinking about the future and sort of taking actions now that might impact that, walk through some of the needed registrations, the mentor-protege joint venture issues, and then sort of ending up with some of the IP questions and protecting your IP that people need to think about as well. So first and foremost, as you're thinking about going after things, I think something people should really start thinking about is, well, should I bid this myself, or could it be possible for me to create a subsidiary and bid this through my subsidiary instead of through my own company? This is something that certainly larger businesses do all the time. And a lot of times small businesses don't think about it, or they think it's a big administrative headache, or in certain cases where like 8A and things, which I'll talk about, the subsidiary won't qualify. But if you're going after certain work, the subsidiary can qualify to be a small business, for instance, and there might be good reasons for it. First and foremost, what do you want to do with your company? Do you want to grow your company, maximize its growth, hopefully get a lot of full and open work, and then sell your company at some point? Or are you looking to have a really solid lifestyle company where it's very successful? You're not necessarily focused on value to a third party. You're thinking more about just value to the ownership and the employees and the officers, like in the here and now, as long as it can go forward, and not necessarily thinking about short-term losses or reduction in profits for some future gain that may or may not happen. And depending on where you are, might dictate how you want to play things. If you're looking to stay small for a long time, then this idea of subsidiaries makes a lot of sense. So if you want to be able to stay small, it used to be there was sort of an interstice in the law where you could argue that selling a division inside of a single legal entity, let's say you had an LLC and you had a division that was focused on IT VAR work, and another division that was focused on IT services work, another division that was on cyber, something like that. You could sell one of these divisions if it has its own structure again, arguably, if it was an independent cognizable business unit, you could sell that and divest yourself of the revenues attributable to that cognizable business unit, which was never really clearly defined by the SBA's Office of Hearings and Appeals. However, more recently in 2019, SBA clarified, after a number of companies had taken advantage of that and won size protests, SBA said, no way, we never really intended that sort of gap in the law to exist. So they changed the rule to say that divisions or business units or cognizable bit, whatever you want to call it, those things that if they're in the same legal entity and you sell them, that's nothing more than an asset sale, and you don't divest yourself of any revenues for purposes of calculating your size. But if it's a separate legal entity and you sell that separate legal entity or somehow disassociate yourself from it, including dissolution or transfer of some kind, then it can be treated as a former affiliate, because the separate legal entity, while you own 100% of it or your company owns 100% of it, it would be an affiliate of yours for size purposes. So you'd have to aggregate all the employees and revenues. But once you sell it and you no longer have control over it, if you sell it the right way and it's completely divested, then it would be considered a former affiliate. And under the former affiliate rule, you no longer have to count the revenues to that former affiliate as your own any longer once that sale or divestiture is completed. So if you're thinking about it long term and you have, let's say you're just a vanilla small business, for each one of these divisions or lines of business that you might have, you could separate yourself into like a holding company and a lot of subsidiaries and push that work down into each subsidiary that might be appropriate. And then at such time where you either no longer want to do that line of business or somebody offers you a good price for that line of business, you could divest yourself of that subsidiary. It would become a former affiliate if you do it the right way. And then all the revenues that have been built up in that subsidiary over the years fall off your books for the entire 5-year period of calculation, or whatever the period of calculation will be in the future. It doesn't matter. Under the current former affiliate rule, once you divest yourself of it, it's gone. So if you think about that ahead of time, it works. What you can't do is think about it, or it's a little bit of a gray area, but I personally don't think it would work if it was really challenged, is let's say today you're like, oh man, I've got all this vanilla small business work that I could put in a subsidiary. I'm just going to do that today, and maybe next year or 2 months from now I'll sell it and I can divest myself of all the revenues attributable to that line of business that I moved into the subsidiary. I don't think that would work, because SBA would only go so far back as when that subsidiary was created. And so it's, again, this is a pre-planning tool, something to think about far in advance, maybe even right now. And start having subsidiaries and pushing work into subsidiaries so that if you're allowed to, I'll get into the restrictions in the next slide, because then in 2 years or 5 years or 10 years, when you might say, oh, I really wish I could stay small, if you're set up with a number of subsidiaries, you could divest yourself of 1, 2, 5, whatever of these subsidiaries and lose all the revenues. So, but again, that would take pre-planning. Some of the restrictions, though, if you're looking at it, this works for small business, and it can even work for a hub zone given the new rules. What it can't work for is 8A, WSB, or SDVOSB, because the status for those programs cannot be attributed to a subsidiary, even if that subsidiary is wholly owned. But if you are an 8A company, or you are a WSB, or you are an SDVOSB, that generally speaking, the work in a 100% wholly owned subsidiary that you are performing is still considered to be your work. So for 8A, you have to promise SBA that you're going to spend your full time and full effort towards your 8A company. And you might think, well, if all this works in subsidiaries, how am I doing that? But if the subsidiaries are 100% wholly owned by the 8A firm, essentially making the 8A firm the parent company of all of these subsidiaries, then any of the effort that you as the 8A owner, the person upon whom eligibility is based, any of the time you're spending in those subsidiaries is considered time in the 8A, so you're not violating that rule. So this kind of setup could work. so long as all the 8A work in this example is kept at the parent company level. But if you go bid on a vanilla small business contract, or you go bid on a, if you're an 8A WSB, you'd have to keep that up as well. But if you have a hub zone contract and you can get your subsidiary, one of the subsidiaries, independently hub zone certified, you could move or bid on the small business or the hub zone work, again, potentially, using these subsidiary entities. And again, that would allow some of the flexibility down the road if you're growing out of your 8A or you're hitting your size standard and you want to stay, you're only in year 6 of the 8A program, but you're at risk of sizing out. You could divest yourself of these subsidiaries to potentially stay in longer. Now, 8A has all these other rules, so does like EDWSB, about your net worth and your total assets and all of that. So that's another layer or wrinkle, like about whether or not selling subsidiaries can help you in that context. It's fact dependent on your situation. But for just small business, if that's what you're worried about, is sizing out of your small business size status, this subsidiary idea and divesting yourself of subsidiaries can work very, very well. Now, sometimes past performance and other issues come up about, hey, well, I have some past performance. What can I really use that? Can I bid on things using the past performance of my subsidiary entities? Generally speaking, the FAR allows for that. Now, there's some risk that an RFP might try to limit it and say no affiliate experience is allowed here. However, that's most likely protestable because there's really no justification for it. It just simply limits competition, so long as the subsidiary entities have some sort of quote unquote material involvement in the bid that one of the other affiliated entities is going after. The best way to overcome this is, I guess if they're a subcontractor to you, that would be one way, but you don't even need to do that. You can have it so that they're providing some other type of support. So if most of your experience is in your 8A, go back to that example, and you have a bunch of subsidiaries that are doing just small business work, you could have the 8A company support the subsidiary with like what I call reach back support, where the subsidiary needs some sort of subject matter expertise and the 8A company has it. You put that into your proposal. You put in the proposal how all the affiliates are helping you out, how they're all going to work together and provide specific support to the subsidiary or the entity. It could be the prime entity too, the parent that's bidding the work, how all these other companies are going to be supporting you. Ideally, you have some sort of written documentation to that effect as well to further sort of concretize the relationship so that if you are challenged or if the agency is looking at it, it gives you a really good argument as to why all that experience and past performance from the entire family of companies should be attributable to the entity that's bidding. So if you do this and if you plan it pretty far in advance, you can get all these advantages and be able to then divest later. Another thing to think about when you're first starting your entity or when the entity is still relatively small is what's your corporate form? I know I've seen a lot of people, there's an inordinate number of small business government contractors that elect to be taxed as an S corporation, whether their corporate structure is an actual corporation or it's an LLC. They elect to be taxed as an S corp in order to get certain self-employment tax savings is usually the main benefit. But that can be short-sighted because you might get some benefit now, but if you grow and you're now close to a large business, or let's say you have some private equity or venture capital funding that comes in, they're really interested in investing in your company or just buying you entirely. If you have elected and you are still being treated as an S corp, and you are not allowed to be owned by another entity, another corporate entity, a C corp or an S corp or an LLC, whatever, it'll blow the S election. And so when you're purchased like that, that blowing of the S election has major tax consequences for the owners of the S corporation, because in most situations, it's treated as a total divestiture of the assets, And so you can be taxed on the full value of that, even though you might have only gotten an investment and only been paid for 20% or whatever from the investment entity that's investing in your company. Whereas if you're an LLC, that doesn't exist. You don't have to worry about that. So it's one of the things to think about depending on what you're going to do. If you're like, look, I'm never going to ever want to take venture capital. I'm not looking for entity level investors ever. I'm going to have a great lifestyle company. I'm not looking to sell my business. I'm looking to pass it on to my kid, or I'm looking to just ride it out until retirement. Then who cares? S election might be great. But if you're thinking down in the future, you might want to think twice about the S election. Similarly, if you're talking about creating a C Corp, there's really no reason for a small business to be a C Corp. You have double taxation. I mean, I shouldn't say never. There might be some reason why you're doing it. But really, the main reason people select to be a C Corp is if they're going to try to do an initial public offering, because you have to be a C Corp to be a publicly traded entity. Most people don't go that route. So in 90%, 99 maybe percent of circumstances, for small business federal contractors at least, being a C Corp doesn't necessarily make sense. And also think ahead too about if you're creating a subsidiary, you're creating a new entity or a joint venture to go after things, do it well ahead of time. Get your EIN, get your DUNS, and I know some of that's being phased out with the new SAM systems, but get all these certifications up front. Set up your LLC, set up your entity well ahead of time. You don't even need other JV partners. You can set up the LLC today and use it 10 years from now. And as long as you're paying your dues, which is not that much every year to the state, you can have that entity ready to go in case some RFP comes out and it says you have to have a separate entity, right? So it just gives you that kind of flexibility. And also, again, make sure you're registered in SAM, because getting registered in SAM and getting it fully activated with DLA having to get you the cage code and everything can take time. And we've seen people get stuck under STARS 3 and COSP 4 where they just didn't have the time to either get their joint venture together, get the separate entity together, get it fully registered in SAM, and they ran out of time, and that was a major problem for them. And that's where we kind of get into some of these necessary representations and certifications that we recommend that you also think about well ahead of time to push forward. And I think, Megan, you want to kind of take people through some of these things?
Yeah. So we can't stress enough how important it is for preparing for a bid, particularly, I mean, if you're going to form a subsidiary or if you're going to form a joint venture or any entity that hasn't, already been set up to do business with the federal government, that you have to get your SAM registration in place. You may or may not be aware of the very, very recent changes to SAM and to DUNS and how all that is working. We're kind of following it, in real time as it gets rolled out, but it's important to make sure that when you're going to register for SAM, for any new entity or joint venture, that you have your tax ID number and you also have the bank account information. Sometimes this can take longer than the estimated 7 to 10 business days. Right now, we are, I think, estimating around maybe 20 business days or so for the entire process. With this change, as is kind of discussed in a couple bullet points below, from the DUNS number, from the DMB number to this unique entity identifier number, the UEI, which is now what's going to be used rather than the DUNS number. With that change, the process might speed up eventually, but given the very recent change, it's likely that things are going to get delayed rather than sped up, at least initially. There are, a significant number of entities being created day in, day out. It does sometimes take the IRS a little bit of time to push out a new, tax ID number. You also want to have the bank account ready to go so that you can input that into your registration. For STARS 3, just kind of, going back a little bit, but we know that some JVs that submitted for SAM over a month ahead of time and still get their registration finalized. So with Polaris now that it's on pause, you might be able to get it done in time, even with the pause, but we don't know how long this pause is going to be. So it's important for all either entities or JVs, if you're not registered in SAM, that you start this process as soon as possible. If you don't need it, then you don't need it, but it's important to start it. In order for joint ventures, so you're supposed to designate more or less in SAM that a joint venture is just that, a joint venture. There isn't really an easy way or quick button to do this. The only way in order to do this is to designate the immediate owner as the managing member or the protege or the small business party to the joint venture. So you can't input the names of both owners. So what I have seen sometimes is someone will put the company in the JV, then they'll put in the managing member as the immediate owner, and then they'll put the partner venture as the highest level owner. So, but that would essentially mean that the partner owns the protege, which in turn owns the joint venture, which isn't technically correct. So you want to make sure if you're doing a joint venture SAM registration that you list the managing member as the immediate owner in SAM, but there is no way to designate both. So just keep that in mind. This applies for everyone. You have to be active, the company, in SAM prior to proposal submission. So even if you've submitted all of your information, it takes days to officially hit the button, to activate the registration. Even if you've done everything up into necessary to get active, but you're not active yet, you cannot bid until it says active, and it has to be active before the proposals go in. So we can't stress enough how important it is to just kind of plan ahead and to have the SAM registration, as far in advance as you possibly can. It's also important to make sure that your subs are also registered in SAM. So subcontractors are not necessarily required to be in SAM, but it's helpful to have their certifications in terms of size and status, and just so that they've kind of done their due diligence and their registrations with the government as well. So you can see their reps and certs and things along those lines. You do not want to forget to upload the notarized entity administrator appointment letter to the Federal Service Desk. This is critical in order to keep the registration active. And then another very important point, if you haven't already done so, you need to verify your identity in SAM. If you're not verified, you could lose the ability to register and update, and the entity could just go inactive or deactivated. And as we've already discussed, you have to be active in SAM in order to bid. You also have to be active in SAM in order to get payments on contracts. So if you haven't gone through these steps, it's important to do so as soon as possible so you can continue to stay, up to date. You can go to the next slide, Si. Si, can you go to the next slide? Just as a kind of a point for representations and certifications, to make sure your SAM is up to date before you submit a proposal. Otherwise, you'll have to include, manual reps and certs essentially with your proposal submission if for some reason SAM isn't up to date. But the easiest thing is to do SAM. One thing I did want to point out, and this is somewhat related to SAM, but also somewhat just separate in terms of the required representations and certifications, is for WSB, and this is still a relatively new process and people are still kind of working through the kinks, but you have to be either verified by SBA or approved by SBA as a women-owned small business prior to submission of proposal, or have submitted a complete application to SBA and not received a negative determination. So it's just important to make sure that WSB certification is no longer a self-certification. You have to actually, physically go and do the application with either SBA or an approved third party. And then you can bid as long as you've submitted that full complete application to SBA. So just want to make sure that that's done and it's just clear that it's not a self-certification. Obviously, 8A is not a self-certification. Hudson isn't a self-certification. SBVOSB is still a self-certification except for VA procurement, but that will be going away January 1st of 2023. So it's just kind of important to keep all of these representations and certification requirements in check. So some necessary approvals and kind of compliance thing that we want to just go over because mentor-protege agreement is such a big tool that people are using that we've gotten a lot of questions in terms of, oh, well, Polaris just came out, I want to form a mentor-protege real quick. Well, unfortunately, it's not real quick. It's about 90 to 110, roughly 105 days to review and approve the mentor-protege agreement. So the biggest thing that we recommend is doing this preemptively. You can't decide, maybe you can with Polaris given the pause, but again, we don't know how long this is going to be. But once a solicitation is released, you do not typically have then 3+ months to wait to develop your proposal and submit a mentor-protege agreement and wait for the approval. So this is something that really does need to be done in advance. There is no law or regulation which requires the government to allow, a procurement to be delayed for mentor-protege to be approved. If SBA takes, too long, in your opinion, then, there really is no recourse. So this is something that you need to plan for in advance. And I will also caution mentor-protege agreements are not really necessarily meant to be entered into for one specific contract. It's supposed to be the 6-year relationship that a mentor provides to its protege. As a protege, you're limited to 2 mentors in your lifetime. If you are forming a mentor-protege relationship with, one mentor for one procurement and that's it, you're kind of losing a lot of the benefits that you would otherwise be getting. So it's really important to kind of think before you start entering into these agreements. But also keep in mind that they do take some time. Next slide. So teaming agreements, often people, is a question that we get. They want to enter into for a various wide range of procurement. At a high level, though, teaming agreements are generally unenforceable because it's an agreement to agree. You're essentially agreeing to enter into a subcontract later on upon, potential events that may or may not occur with conditions, terms and conditions that haven't yet been finalized. It's not necessarily, though, enforceable as it relates to certain agreements in the teaming agreement, such as exclusivity. So the way to kind of think about this is it's generally unenforceable for post-award obligations, meaning enter into a subcontract, but it's not necessarily unenforceable for things like exclusivity. So if you are a prime or a sub and you're agreeing to enter into an exclusive teaming agreement and you want to violate that, that doesn't mean just because the teaming agreement might be unenforceable for the subcontract later on, it doesn't mean that it's not enforceable as it relates to exclusivity. So, we have to look at the terms, the specific terms, the applicable law, things along those lines, but that's kind of something just to keep in mind as you're developing these teaming agreements. We often get the question of, oh, I know that this procurement is coming out in a year and I want to lock someone in now. Okay. Well, without having the specific terms of the solicitation and without having, kind of everything hammered out, it's very hard to create enforceable provisions in that type of agreement because it's super speculative. But for a prime, I can understand why you may want to lock someone in and agree that they're going to team only with you. But at the end of the day, they may or may not have to issue a subcontract. So, however, there is always, the caveat of fraud in the inducement if the, prime never intended to award the subcontract to the teaming partner. But it's just very important things to keep in mind as you're preparing for procurement. What does my teaming agreement say? Is this enforceable? If it's enforceable or unenforceable, what provisions does that cover?
Yeah, and Megan, can you hear me?
Okay.
Yeah, okay. So we have a question that came up about is it required for a subcontractor who represents themselves as WSB to be verified by SBA? I know this is like a moving target recently.
So the answer is no. You can still continue to self-certify for subcontracts, and you can also as WSB, and you can also continue to self-certify as WSB for non-WSB set-aside contracts. So if you're bidding on, let's say, a small business prime contract, and you also check, say I'm also WSB, you are not required to be verified by SBA as a WSB in order to make that certification, and the agency is permitted to take credit for both small business and WSB, but that's only because the contract was set aside not for WSB, but for small businesses. Okay, so turning back to teaming agreements, subcontracting teaming agreements definitely still have value, and people are going to continue to enter into them, on a very routine basis. But you want to make sure that there's at least, terms discussing who is going to do what. What are the specific types of tasks each is going to do? What is the percentage of work? Do you know pricing already? A lot of times people do not include pricing, even though they've kind of already agreed to it because they've prepared their proposal based on certain pricing. If you enter into a teaming agreement well before it's time to do pricing, you may want to consider amending or modifying it later on to include these specific terms to make it clear that this is going to be an enforceable teaming agreement. So at least with our clients or a lot of teaming agreements that we've seen, Virginia is a very common and popular choice of law for teaming agreements in Virginia. So the courts view teaming agreements largely as unenforceable, unless you have very specifics in terms of maybe you have a subcontract that's even a draft of it that's attached to the teaming agreement, and all you have to do is execute it when you get the prime contract award. Do you have the period of performance, pricing, positions? What is the exact scope? What is the percentage? How definitive is the agreement? As you can see on this slide, one option is to full-on negotiate the subcontract before proposal submission and attach it. A lot of companies don't want to take the time to do this, but it may be the only way to enforce the agreement down the road. So you have to keep that in mind. And then another option, although it's more risky, is to have a term which states that until a subcontract is signed, the teaming agreement will act as the subcontract. So here, though, if the teaming agreement simply states, well, the company is going to get, 20%, like that's it. Okay, 20% of what type of work? What's the pricing? What are the labor categories? Things along those lines. So you got to be careful a little bit with teaming agreements. They're used very frequently, and they can have significant value, but you want to make sure you're thinking through the terms and conditions.
Yeah, another question. I think they were asking what you were talking about, Megan, earlier on the WSB question. And just to clarify, we were talking about woman-owned small businesses. That's WOSB, woman-owned small business. That's what we were talking about.
Yeah, sorry about that. Acronyms are pretty common in GovCon. If you have any questions, it looks like Sai is monitoring those, I'm happy to answer. The reason teaming agreements are important is not just to kind of get the parties thinking about who's doing what, but also in the event of a size or protest, and as it relates to the ostensible subcontractor rule. So one of the bases that companies often file size protests is that the prime contractor does not have the ability to perform this contract by itself. It has to be unduly relying on a subcontractor to get the contract or to perform the primary and vital requirements of a contract. So if a size protest is filed alleging a sensible subcontractor affiliation, one of the first things that the SBA is going to ask for is a copy of the teaming agreement between the parties. And the SBA will look at it to see, okay, who is going to be doing what? Does it describe the task? Does it confirm also that the prime is going to be managing the contract, is going to be doing the primary and vital requirements? Or are they unusually reliant on a subcontractor? SBA will also look at the proposal that was presented to the government to see, does the proposal line up with the teaming agreement? If not, you better have an explanation as to why. But we want to make sure, especially in set-aside contracts, that the prime is doing the contract management, is performing key requirements, primary and vital, is doing the majority of work and complying with the limitations on subcontracting. So it's very important to keep that in mind when you're drafting your teaming agreement and your proposal, to make sure that you are complying with SBA's regulations at all times. Just as a side note, this rule does not apply, the ostensible subcontractor rule, to a similarly situated entity. So if you are bidding on an 8A set-aside contract and you want to subcontract with another 8A company, you are more or less essentially free to give them whatever they want, or whatever you want, and it would count because they're both 8A, and assuming they're both companies are small under the NAICS code that is assigned to the procurement or the subcontract. So it is a tool to use if you are looking to subcontract with a company that shares the same size and status as the prime.
Yeah, on that point, just to be clear, when Meghan said it's the similarly situated is, are you small as determined by the size standard applied to the prime contract or the subcontract, is important to note that just because, say, the prime contract is a $16 million size standard or something, the subcontract, if it's for a portion of that work that could arguably be categorized as something else, some other NAICS code, the size standard could be different. And they could still be considered a small business in theory, even if the NAICS code that applies to the subcontract is a higher size standard, like say 30 million or something like that. So you could still be a small business, even though you are too large for the prime contract, and still be a similarly situated company in certain circumstances, if it works out that way. Another question I think, Meghan, we get all the time is, under the ostensible subcontractor rule and the risks, if you are in a mentor protege and you're in a prime sub and your mentor is a subcontractor, are you immune from this, or can you still be affiliated even though you're a sub mentor?
I mean, the assistance goes so far as you're providing the assistance sought out in the mentor protege agreement. That doesn't give you carte blanche authority to not comply with the limitations on subcontracting. And it depends, what does the solicitation say? I mean, just because you have a mentor protege does not give the protege the ability to essentially pass through work to the mentor. The protege still needs to be involved. So even if you're bidding as a prime sub, or a JV, SA will still want to see that the prime is doing, what they need to do. If the mentor protege agreement, specifically calls out certain tasks that a mentor might help perform on a contract, like for example, it's very common for a mentor to provide bonding assistance or indemnification or things along those lines in a construction contract, or all this equipment and things like that. That could be easily spelt out in a mentor protege and not really, it would be covered pursuant to, but you're not completely immune just because you have a mentor protege.
Yeah, that's an important point.
So on the flip side of, instead of just subcontracting compliance in general, so on a set-aside contract, the prime has to comply with the limitations on subcontracting. So we've included the limits here. So for services contracts, the prime cannot sub out more than 50%, of the amount paid by the government, essentially for the services. You can exclude certain materials and supplies, or possibly ODCs, other direct costs, if there's no small business capable of providing them, but it's more or less a 50% self-performance requirement. Companies often go with at least 51. 1% is not too much wiggle room, so we would try to recommend a little bit higher because it does get a little muddy during contract performance, but the regulation states 50%. It's also 50% for supplies. For specialty trade contracts, it is 75% or a 25% self-performance requirement. And then just general construction, you can sub out up to 85% but there is a 15% self-performance requirement. And for construction, the self-performance requirement often is in the management of the contract. Typically, the day-to-day labor is often performed by subs, which is perfectly fine as long as the prime is, doing that 15%, but then also managing kind of the on-site performance of the contract. So it's important to keep these limitations in mind to make sure you can comply before bidding. Again, a similarly situated subcontractor would count towards the percentage of work that a prime contractor would perform. So if you're doing, an 8A contract and you have a similarly situated 8A subcontractor and you're only going to perform, let's say 40%, but this other 8A is going to perform 20%, collectively you could still be complying with the limitations on subcontracting because the 8A companies are doing 60%. So as it relates to joint ventures, because we get this question all the time, what do joint ventures need to do in order to be compliant, in order to bid? So this is where the mentor protege often comes in, is because the key for SBA is whether, regardless of the type of set aside, are all parties to the joint venture small under the NACE code that's assigned to the procurement? If the answer is yes, then you're allowed to, form a joint venture without a mentor protege. If the answer is no, you absolutely have to have an SBA-approved mentor protege agreement in place and approved prior to bidding on that procurement. So that is kind of the first step. What do I need a mentor protege? No? Okay, cool, then I'll just form it. In that case, you might be able to get the JV formed in about a month without the mentor protege. But if you need the mentor protege, you're looking at 3 potentially longer months. The managing member to the joint venture has to qualify for the type of set aside you're going after. So typically the joint venture is comprised of, let's say, like an 8A company and then maybe a small business or a WSB. But if you're bidding on an 8A contract, the 8A party, even though both are small and have different socioeconomic statuses, has to be the managing member. While the WSB is a small business, and that's great, they still have to kind of take a back seat and be the partner venture in that joint venture. The JV has to be unpopulated. So the joint venture entity is really just a shell, it's a pass-through. It doesn't have employees. However, it can have administrative personnel that can help with the need for a facility clearance. If the joint venture wants to populate it, self with an FSO or something along those lines, that's permissible. But a joint venture cannot be populated with personnel that will perform on the contract if the JV is successful. In terms of how long are joint ventures good for, because joint ventures are in SBA's mind a limited purpose entity. So JVs do have a shelf life, but the shelf life doesn't start until the first contract is awarded to the joint venture. So like I said, you could form an entity that you want to use as a JV like 10 years ago, and it just sits there and nothing happens with it. Okay, well, that's fine because nothing has happened with it. And then you decide, okay, I'm going to make this entity this joint venture, and then we're going to bid on work. Great, you can do that. If that joint venture is successful in getting the contract, that is when the timeline starts. Similarly, if a contract is novated to the joint venture, so the joint venture didn't actually bid, but acquires a contract, that would also count to start the clock. And whatever that first date is, the JV then has a 2-year shelf life. But that does not mean 2 years and then I'm done, have to terminate the JV, have to terminate all my contracts, that's it. You are no longer eligible after that 2-year mark to bid on new work. But you could keep getting work if you bid within that 2 years, and you can keep performing on work if you've already received it. So it's important, while there is a limit on the timeline for JVs, JVs can go on for a significant period of time, depending on the contract.
Yeah, exactly.
So kind of going back to the performance of work requirements a little bit as it relates to joint ventures, there are 2. So the JV itself has to comply with the limitations on subcontracting that we previously discussed. So the JV entity, which again is unpopulated, so it's a shell. You essentially take the aggregate of the percentage of work that's being performed by each party to the joint venture collectively. And whatever that percentage is, that percentage needs to comply with the limitations on subcontracting. From there, you have to look at that set percentage. So if you have, JV partner, managing partners performing, let's say, I don't know, 30%. JV partner 2, the large business is also performing 30%. Okay, great. We're at 60%. So that complies, assuming a services contract, with the limitations on subcontracting, because collectively the parties are performing 60% of the work. Of that 60%, the qualifying party to the joint venture, so the small business or the protege or what have you, has to perform at least 40% of the work that's performed by the joint venture. In my example, where each party is performing 30%, collectively 60, the managing member would be performing 50% of the work that's being performed by the joint venture. Therefore, the JV would be complying with the 40-60 split and the limitations on subcontracting. So it's very important to understand that the small business party, protege, managing member has to perform at least 40%, but it's of a percentage. It's of the work performed by the joint venture. If the JV is performing 100%, then they have to perform, 40% of the contract, but it reduces if you have subcontractors. So it's really important to keep these limitations on subcontracting in mind and these performance of work requirements. It's also important to understand that these apply for each contract period. We often get the question, oh, well, we haven't been complying for the last 3 years, but we got 2 more years left, we're gonna make it up. Technically, you are not in compliance. You have to comply under each contract period of performance with both of these requirements. And it's not something that you can make up later on, because option periods are never guaranteed and you could be terminated at any time. So you need to be very careful that at all times you're keeping these performance of work requirements in mind. And that goes not just for joint ventures, but also for regular prime subcontracts as well.
Yeah, and one thing that has come up on some of these IDIQs is some of these are requiring you to report in every year on whether or not you're meeting the limitation on subcontracting, whether for joint venture or prime sub. And even in cases where there might be a base period of 3 years, and that is actually inconsistent with the SBA requirements. SBA says it's period by period. So if it's a 3-year base period and a 3-year option, as opposed to, or 2-year option or whatever to bring it to 5 years, as opposed to a 1-year base period and 4 1-year options, in that case where it's a 3-year base period, you could be out of compliance in year 1 and make it up in year 2 and year 3 because it's the same period of performance. And what we're seeing is, even in that context, the government, the CO, is still making you report every year and judging you on how you're doing every year, even though the SBA rule says you could make it up if it's a more than 1-year base period. So, but they're allowed to do that, I think, because they're allowed to put like more strict requirements on there or make you report. Some of them don't even say what happens if you are not compliant. And you could probably explain to them, well, I'm not compliant this year, but I'm going to come into compliance because here's what I'm going to do. And if they accept that and you're open with them, they can kind of carry it forward, and you should be okay. But just be aware of that potential inconsistency. Megan, we also got a question. Oh, go ahead.
I was just going to expand on that point. You also have to annually certify every year, certain reports and certifications to SBA if you're in a JV, that you are meeting the performance of work requirements. So even if there is that 5-year base or 3-year base or what have you, our recommendation is to always comply on a year-by-year basis. And that does not necessarily apply to each task order, but the surest way to comply at the contract level is to comply on each task order. What was the question?
I think let's just keep going. We can kind of try to get to them at the end, or we can follow up just because of time.
Okay, yeah, we don't have a ton more slides, but there are some things we do want to get through. So in terms of joint venture compliance, what we've talked about kind of previously is just kind of performance of work requirements, things like that. But what is one of the key main requirements to have a joint venture eligible to bid on a procurement is that you have a compliant joint venture agreement. So every type of set aside has a pretty much similar list, nearly identical list of what needs to be included in a joint venture agreement in order for it to be found to be compliant. So you want to make sure that you have a compliant joint venture agreement prior to bidding. I will caution though that simply having, checking the box in terms of, okay, do I have a list or a provision that says profits will be split commensurate with work performed? Great, okay, cool, next one. Just having those few items in the agreement does not necessarily mean that your agreement cannot be found to be non-compliant. SBA is really cracking down on a lot of the requirements, whether that be through size protest, status protest, things along those lines. OHA, SBA's Office of Hearings and Appeals, has kind of interpreted some of the joint venture agreement requirements. So you need to make sure you're being mindful of those, largely over who is providing what equipment, who is providing what staffing. Is there a level of detail in the solicitation that you can provide information? Is the managing member really the managing member? Or is there too much negative control or unanimous consent type rights to the partner venture? There's a lot of things to kind of think through rather than just going through this like checklist more or less. And if you don't comply with those requirements as they've been interpreted by OHA, then you can easily be found non-compliant and lose the contract award. So your joint venture agreement is key. It's also key that you have this agreement in place prior to proposal submission. SBA's regulations were revised to state that you can, essentially amend your joint venture agreement up until the date of final proposal revisions if you need to make changes, but you are never guaranteed a final proposal revision. So you have to go through and make sure when you're submitting your proposal, do you have a compliant joint venture agreement? And to kind of that first point in this slide, does your joint venture agreement line up with your proposal? If your joint venture agreement says, Joe is going to be the responsible manager for the JV, but the proposal says Susan is going to do it, why is there a difference? What is the difference? It needs to be consistent, otherwise SBA could find potentially a non-compliance issue. So it's really, we cannot stress enough how important it is to have a compliant joint venture agreement in place prior to submitting a proposal. And it's not just as simple as, do I have every single item in here that 13 CFR 125.8 says I need to have? There's a lot more to it. So it's important to keep that in mind as you're submitting a bid as a joint venture. The last just on this slide, really quick, SBA no longer approves joint ventures for 8A, all 8As. They only review and approve as it relates to sole source contracts. So you often get questions like, oh, I have to submit this to SBA. How long does that take to review and approve? Well, if you're submitting a bid for a competitive contract, there is no approval process. Something else to keep in mind, and this is helpful, we often, why maybe would I want to form a joint venture? There's a lot of reasons why you might want to form a joint venture, but profit split is kind of a way to keep a company potentially small for longer. So in the prime contract, prime contractor world, you take on 100% of the receipts of the prime contract, regardless of if you have subcontractors or not. In the joint venture world, however, SBA's regulations provide that you only take on the receipts that are commensurate with the work that you've performed. This assumes, a revenue-based size standard. But if you're performing on a $10 million contract and you perform 40% of the work that the joint venture performs, you only take on, $4 million as opposed to that full $10 million. So it is a way to help kind of keep, those like larger smalls a little bit small for longer. So that's another, tool to keep in mind as you're going through bidding. Profits I mentioned, you do have to split profits commensurate with the work performed, but because the joint venture is unpopulated and the way companies often price their proposals in terms of aggregating or essentially kind of doing like a blended rate, that already includes profit. So the joint venture often really has nothing left over. Think about it in a construction context. Does it make sense? Maybe, maybe not. But these are all kind of things to think through. And then the last thing let's see. Okay, joint ventures are becoming increasingly popular because of these huge GWAC stars, CISP4, Polaris. What does the solicitation say in terms of how is a joint venture able to utilize the experience, past performance, qualifications of its members? This is obviously a big issue that was flagged for CISP4 and now also again for Polaris. So the next slide kind of touches on just you need to review the solicitation requirements and see what it says. Some joint venture considerations are, kind of getting creative with the form of the JV. Can you do a JV within a JV? And the answer is largely no, but maybe yes, in a very, very limited circumstance. And kind of, walking through ways to do it. But I know we're getting short on time, so I think we're just going to move right along.
Yeah, it's one of those, it's a very gray area, maybe deep gray. Well, let's see.
It's important, I wanted to flag that you need to, when a solicitation comes out, and again, this is like a final solicitation, not a draft solicitation, you want to go through and review the requirements very carefully. What does it say as it relates to a joint venture? Can you rely on the experience of your mentor? If not, or if there is a limit, is that limit permissible? What are the facility clearance requirements? Does it state that the offeror has to have the clearance? If the offeror has to have the clearance, the offeror is a joint venture. You need to review these ahead of time before you're bidding, because if you assume and your assumption is wrong and it's something that you should have asked, you have lost all right to challenge that in terms of a protest. So you need to be very careful when you review it. If you're like, well, I think this is what it means, no, you need to get clarification for what it actually means. And if it doesn't mean what you think it means, then you need to consider filing a protest. So it's very important. But again, this relates to final solicitations. You cannot file a protest on a draft RFP. And we have seen time and time again, very different requirements from a draft to a final. So you just want to keep that in mind. I'm going to turn it over to Sai for the last kind of couple slides.
Yeah, or even final to real final. It's been changing. All of these have been changing so much. The last piece, and then we might stay a little over time to answer some of the questions, is protecting IP. One of those things that we see, or I see quite often, is people maybe not thinking really far ahead or making assumptions about their teammates. So if you're going to be a subcontractor, you got to avoid things like work for hire language, or language where you might be bringing something to the table and you weren't really careful about something. You're just eager to get in and get the work done. You sign a subcontract or something, or even a teaming agreement where it's clear that you're bringing something and you're giving all the rights away. Make sure that if you created something at your own expense and it was yours, that you're clearly protecting it. Also, write it down. Like, what is it that you're bringing? If you're bringing something to the table, be able to identify, be able to know where it is, what's being included. If you're going to bring something to the table and the other party's bringing something to the table and you're going to join them together, who owns that joint IP? One of the main things that is kind of shocking to people is if you have jointly created IP and you don't say what's going to happen with it, it's owned 100% by both parties, which means either party can do whatever they want with it, including if you get angry at each other and a party is willing to kind of cut off their nose to spite their face, they can take the intellectual property and give a royalty-free license to the world for it, which basically eliminates the value to both of you, but they did it to spite you. That is perfectly fine. So what you need to do in the cases of joint IP ownership is make sure you have some sort of cross-license agreement which restricts that kind of behavior, and make sure everyone's clear as to who's going to have what rights after this contract is done with whatever's created. Because just because the government's paying for it, generally speaking, the government gets the rights to it, but not the ownership. You generally keep the ownership. And if you're jointly developing things, you might jointly have ownership, and that needs to be addressed so that the parties don't, or one of the parties doesn't just run off and do something. Realize going into this, is this a commercial product? If it's a commercial product and you're a subcontractor or you're a prime, make sure that you realize that and you're not using the non-commercial FAR clauses and legends. Actually say, this is commercial. Here's my license agreement. this is what I'm putting in here. Government, I'm giving you certain rights based on the license agreement because I'm providing a commercial product. Make sure that's clear at the outset so you don't get into issues. And if you're a prime contractor, make sure that you're getting all the rights from your subcontractor and that the subcontractor knows that way ahead of time before you're bidding on something, because you don't want to get into a situation where you propose something, then you say, all right, we won the contract, let's get ready to go. And now you realize the subcontractor didn't intend to actually give you the rights that you promised in the proposal, which is probably unlimited rights. And the sub says, wait a minute, this is a commercial product, here's my license agreement. And you say, wait a minute, I promised the government that, or I didn't reserve any rights. I didn't tell them this was commercial. I didn't tell them it was restricted rights software or whatever it happens to be. I just put in a proposal, which the government then is reasonable to infer meant they get unlimited rights in that. So there's an issue there. And you can be in breach of contract right after award if you can't provide what you promised because you didn't talk to your subcontractor ahead of time. So this is all of these issues are pretty important issues. And so then I kind of wanted to go through a couple of these questions a little over time, but one of the questions people were asking about is 8A joint ventures. Did people hear right that it doesn't have to be approved anymore?
Yes, absolutely. Only for 8A sole source. And it does take time. And, you know, I have unfortunately heard of situations where SBA sits on it and the agency goes to the next kind of, you know, just the next option because they need to get work. But because of that issue, that was happening not just in the sole source context, but also in the 8A competitive world. Now, because of the elimination of the, you know, approval process by SBA, you can go bid, form a JV, bid on an 8A competitive contract, and SBA is, you know, none the wiser. You know, they don't have to get involved. They will definitely get involved if there's a protest or something along those lines, but there is no formal approval and review process for 8A competitive contracts any longer.
And what about if you enter into a mentor-protege agreement and you're not similarly situated, you're just a mentor-protege with a large business mentor, and you get in the approved mentor-protege agreement, how long does that last? And do you have to get it approved for each bid?
So the mentor-protege is up to a 6-year term. SBA has used to require way back in the day kind of annual reviews and approvals. Now it's essentially a 6-year term. You do have to submit annual updates to SBA every year, but as long as that's in place and approved prior to proposal submission, you're more or less good for 6 years. There is no separate review or approval from SBA of your JV just because you happen to be mentor-protege, nothing along those lines. You just want to make sure you're actively doing and complying with the annual certifications, annual reports for mentor-protege each year. But other than that, it's pretty much good to go for 6 years.
And then lastly, I've gotten this question before too, asking about if you have a HubZone company and you have HubZone employees, must the HubZone employees perform documented work, or can they just be sort of paid and in a designated zone and just hold an employee slot? The rules are not super clear on this point, but I can say that in audits or in investigations that I've done with HubZone companies, one of the things SBA did look at is whether or not the employee was actually doing something legitimate. So SBA does look at that when they're auditing, and in the ones I've done were actually more investigations. They were false claim investigations to make a determination as to whether or not the employees were really doing anything on the project or if they were just hired to do nothing. But what's interesting about that is the rules don't really have anything that's that strict. And SBA has said that using some of these companies that are out there that allow you to kind of share employees, so because you know it has to be 40 hours, and so you could in theory share an employee with multiple other companies or get them through sort of a hub zone employee, PEO, or whatever you want to call them. SBA did bless that idea because the employees are still being paid. But part of the idea too is that they get some of the experience. So I think it could be risky to just hire a bunch of people and have them, do nothing or watch Netflix or something like that in order to qualify. So not really recommended. But yeah, this will all be available. The slides will be available. This will be published on our YouTube page, and so it'll be live there in perpetuity. But if there's any other questions, feel free to reach out to us. And here's our information. And thanks everybody for coming this afternoon. And I hope you have a great rest of the day.